All right. Hey, what's up, everyone? It's Kirk here again at Option Alpha. So thank you so much for joining me back on this episode. So it's actually episode 16, which is crazy. We've gone through this many episodes, but hope you've enjoyed all the ones we've done so far. Last time that we got together, we looked at some new research on zero DTE time decay. So looking at tracking prices of zero DTE options minute by minute for an entire month just to see what that kind of time decay curve looked like. And it was pretty fascinating. If you remember, if you don't, go back and take a look at the last episode that we did. But in that episode, we essentially saw that the zero DT time decay for most spreads that you would typically trade, for a regular trade, like real spreads that you would trade, typically followed the same type of curve or architecture of a regular time decay curve that we're used to, or a theta decay curve. Just it was more compressed into a shorter time period. So rather than looking at an option contract over 90 days or 60 days, you're looking at something that was much more compressed over a single day, but you had that real sharp drop off at the end of the trading day. And so we saw this in our research. So what we're going to do today now is we're going to actually change it up a little bit, and we're going to show you how you can use the new zero DT backtester inside of Option Alpha. If you're an Option Alpha user, you're also connected through Tradier, then you can go ahead and backtest these strategies using 1 minute level data, and then automatically convert any of your backtested zero DT strategies into an automated strategy that you can trade directly. So that's what we're going to show you here today. I hope you guys enjoy it. As always, if you have any questions, let us know, and let's jump right into it. So we'll pull up the slides here, or pull up the screen. Okay, good. So what we're going to do here is we're going to go ahead and we're going to do a little bit of back testing. So inside of this new zero DT back tester, what we did is we completely revamped this, rebuilt it from the ground up. It literally includes minute level options pricing data, which means it is ridiculously powerful and insanely big data that you have access to. But what we're going to do is we're going to start with a brand new back test. So all I'm going to do is go over here on the right hand side, click on that new back test, and we're going to pull up a new back test. We're going to test SPX. We actually just added IWM this week. So that's a new testing symbol that you can go into and test and kind of play around with different strategies. But we'll stick to SPX right now, not only because we did the research on it before in the last episode, but also because it's cash settled. It has the favorable 2656 or 1256 tax treatment, so the 60-40 split. So we're going to do that. And what we're going to do is we're going to test an iron butterfly to start. Now you can see inside of here, inside the back tester, once you select the strategy that you're going to test and expiration, so we'll do zero DT, but you can also test next day. What you can do in here is you can actually select your legs, and you can get pretty specific with this. You can do a delta, you can do a dollar amount. So you can say $5 above and below the underlying price, or a percentage above and below the underlying price, or you can play it off of different legs. So in this case, what we're going to do is we're going to do this short strike, this short put strike. We're going to do this 0.01 above the underlying price closest. So we'll just do it whatever is the closest contract to wherever it's trading. And then what we'll do with the long put is we'll play off of our short strike. So we'll go down to one of these recipes here, and we're going to do this one $5 below our short put leg exactly. So we want to make sure that this one is $5 below our short put leg exactly. So again, what we're doing here is we're saying, all right, set the short put strike at, basically like right at the money. So a penny above or below where the underlying price is. Whatever that one is, we want the long put to be $5 below the short put leg. Now, because it's SPX, there's only $5 increments anyway. So that's the minimum that we can go. We can go $10 or $15, but it's going to be that, and we want to do it exactly. The short call strike, we're going to do the same strike as our short put leg. So notice we're using all types of different recipes here, but we're kind of creating and crafting our own strategy. It's just using just very natural language logic in here. And then the long call strike, we're going to do that one $5 above our short call leg exactly. So this is essentially creating a very tall, very narrow iron butterfly. And again, this is just an idea. We're just testing out an idea to see if this potentially works for our particular strategy. Then we'll do a starting capital allocation. So we can start, $25,000, whatever the case is. Position size, we can just do one contract for now. So you can mess around with this if you want to. You can do up to certain risk amounts for this if you wanted to. Like you could do up to $500 of risk or $300 of risk, whatever it is. And entry time, you can change the entry time here to be something super, super specific. So I can literally say at 9:47 a.m. Monday through Friday, skip FOMC days. That's what I want to test. I want to test entering a new position every single day of the week that's not a Fed day at 9:47 exactly in the morning. So you can put in whatever time you want here to test the logic for this particular strategy. Now, we're not going to include a bunch of any position criteria or entry filters here. Notice you can include ranges or indicators or moving averages. You can throw a bunch of these in here for testing purposes, which we might do here in a little bit. But for now, let's just keep it really simple. And then for exit options, we're going to keep this very simple as well. We're going to let it run to expiration. No profit taking, no stop loss, no expiration, no touching, no nothing. Just enter the position, let it go to expiration, see what it does. And we'll run it for 3 years. We'll see how it performs, okay? So once we're good to go here, we simply hit run backtest, and then we can go over here and view the results. The backtest might take, and again, it's running through basically 3 years worth of minute level data, and combining it actually runs decently fast for as much information as we pull, but it might take a minute or so to pull that information. So, all right, so now we have our results for this backtest. Remember, we're doing an SPX Iron Butterfly exactly at 9:47 a.m., one contract for the last 3 years. And you can see this strategy net was a dud. In fact, it only was up and above water just for a very short, brief period of time. But otherwise, this strategy was a dud. Really didn't do well. Win rate was super, super low, which we kind of would expect. You would expect the win rate to be really low because you're doing a really tall, narrow Iron Butterfly. So you're not expecting this win rate to be insanely high, right? It's not like it's a wide Iron Condor or something like that. But you can see it entered a lot of positions, 663 positions. What I like about the way that we put together this new backtester is we give you all the logs and all the position data, all the information, every single thing, all the fills, all the information. There's a total transparency into like what data went into it. So you can just kind of look through it yourself and see, oh, this one ended up being a winner, this one ended up being a loser, whatever the case is. So you can see all that information. If there were any trades that were filtered out, you can see that here under the filtered out trades. So in this case, we had 24 days were FOMC days, so it didn't trade. We had some other pricing issues where sometimes the data, like the market at that moment in time, has really wide or inaccurate spreads. We filter those out by default. Also, if there's no option available, like if there's no $5 leg available, then we filter those out as well. So we didn't have too many, which is good. But again, it's just trying to create a better, result for you guys by filtering out some of this stuff. If we go down here to the monthly P&L chart, this is very interesting and very fascinating. What I like about the monthly P&L chart when you're looking at an individual strategy, just as a sidebar, is that if you look at the monthly P&L chart, it tells a little bit of a different story. And the different story sometimes can be interesting in that it can tell you just like how frequently you might expect this strategy to perform, where maybe every month it's oscillating, where 1 month it's profitable, the next month it's not profitable, or 1 month it's profitable, 2 months in a row it's profitable, then it takes a big loss. Like whatever that story is that it tells, it just gives you a better idea of kind of what you might expect moving forward for this strategy. So the other thing that I think is interesting is that sometimes, and I personally find this insanely fascinating, but sometimes you'll hear people or you'll see people and they'll say, well, I tried that strategy for 3 months and it was terrible. Or I tried that strategy and it's been amazing, right? And then if you can actually go back and backtest it, you might say, well, maybe that person started in July and, in July they had a winning month and then August they lost, but then they had 3 winning months in a row. So they think they found, the cradle of the lost grape, and that they think they found the golden goose, right? But it's the longer term story that actually, kind of really tells the tale of what's happening here. And this is why I think backtesting is so important. Not that it's going to be perfect, because it's not. And it's certainly not going to be perfectly indicative of what happens in the future. But what you're doing here is you're creating guardrails. You're trying to figure out, okay, am I even driving in the right direction? Am I moving in the right direction? With this one, it had good months. It had good runs, right? If you traded it from, mid-August of 2013 or 2023 up to, for basically about a year, it had a pretty good run and then just got crushed again. So that kind of really tells the tale here. But the end result here is that that's probably not a good strategy to trade, and that's okay. We want these. We want to find strategies that don't work So it can help us not only avoid and wasting our time and our capital, but also gives us ideas on what we could possibly test. So what we're going to do now is we're going to go up here to the compare button and we're going to add some comparisons. So now this immediately gets you into a little bit more of a different view where now you're doing some comparisons and you're starting to add and, compare different strategies. So I'm going to take this strategy here, click on the little three dots on the right side, and then I'm going to go down here to add a variation. What this does is it basically brings up the exact same setup that you already put together. So you don't have to re-put it together again. You don't have to re-input everything. Everything is in here exactly the same. And now what this does is allow you to tweak this and find different strategies or different things that might work. So let's do this. Let's go out here let's go to 12:30 p.m. So let's move our entry time out just a little bit and see if that does any better for us. So instead of entering a position early in the day, let's move that entry time out to just past noon, just past lunchtime. Same parameters for everything. Let's run that back test and see if we do a little bit better. Okay, so while that back test is running, okay, there we go. It's all set now. Now this obviously did a lot better. So not only did the strategy stay above water for a longer period of time, but it ended above water. So it was a huge difference, right? It still maybe is not what we want, but we're starting to build a picture here. We're starting to build a picture of how we can modify and change our testing parameters so that we can try different ideas and different things. So here what we're doing is if you see these two tests now, you can see test A and test B that we've run. Obviously, we know what happened with test A, but you can side by side compare them all the way down. You see the, just little things that you look for, like profit factor was a little bit better. You got your win rate was actually up a little bit. So you entered a few more positions. So not as many positions got filtered out. So maybe pricing and liquidity wasn't so much of an issue earlier, like it was earlier for this testing, but you got a little bit better win rate, which was good. Your return on risk was still pretty good. You saw some good wins, some good losses. So overall, you improved your performance. You generally entered about the same types of positions capital-wise, but just moving out a little bit further in time helped out. So let's just keep going. So let's go down here and let's add another variation here, and let's just keep going out. So let's go out to 1:30 in the afternoon. So let's see if we enter positions not at 12:30. Maybe we push it back another hour or so. Maybe 1:30 does a little bit better. We'll see. Okay, and you can see here this was again wildly different performance here, but significantly better. So if you enter positions at 1:30 versus 12:30, certainly better than entering them in the morning. You did dramatically different. Multitudes of profit higher than the other one. You can see the profit factor was significantly higher. Your win rate was significantly higher. Again, you entered about the same number of trades, so that's good. And you're still taking in positions that were about the same types of positions. You actually entered positions that had slightly lower premium. The entry price on average, if you look across the three strategies, you can kind of almost see the decay happening that we talked about in the last episode, where the decay is happening in the entry price, where the entry price is there, and then by 12:30, it's starting to decay, and then it's decaying a little bit, right? So that's that premium decay. You actually entered the position for less premium, but you got to keep more of it, of course, because the premium, the profitability of the strategy was significantly better. So let's push it out one more time. I don't know where it's going to be at this point, but let's go even further out. Let's go like 2:30, maybe even like 2:45. Maybe that's, so now you're kind of running towards the end of the day. At this point now, you're probably right on the edge where time decay is starting to really accelerate pretty fast. Okay, and in this case, you actually got a little bit worse here at 2:45. So 2:45, your win rate was higher. So from a capital and like curve perspective, the curve may have been easier to stomach as you go. Your total P&L was a little bit lower. Your profit factor was a little bit lower. So all of these things you can start to see now the decay is, happening a little bit more rapidly towards the end of the day. So let's actually back it off just a little bit. Let's add another variation. Let's do maybe 2:30. Maybe just back it off a little bit. Maybe don't go so close to the end of the day and see if this one actually performs decently well. So we'll let that roll and run here. Okay, and this one actually is very interesting. So this one, not only was this one just a little bit better than the 2:45, so kind of backing it off towards the end of the day, ended up working out okay and decently well. But what you also see with this one here, test number E, which is more of this like purple or magenta, is that it stayed above water a lot longer. I mean, so you really didn't stay underwater significantly long. And in fact, you were in kind of the green, running on house money, if you will, running on profit for a longer period of time. So the win rate was a little bit lower than if you went towards the end of the day, but that's okay. You still made some more money doing it. And you can see you captured just a little bit more premium. So just kind of backing it off and moving it towards about 230 ended up working out decently well. And that's probably a pretty good strategy to run right there. It's like you could still go through here and kind of optimize it for a lot of different things. But ultimately, it ended up being a pretty decent strategy to run. So let's go ahead and let's remove this test. Let's remove some of these ones that we don't want for now, because we're going to kind of mess around with this new resulting kind of new base model here, which is going to be test number 8. This is going to be our 230 test that we're going to use. So, okay, so that one ended up doing pretty well. So let's go in here and let's create some new variations again. So we're going to just use this as a benchmark here and create some new variations within this. This time, what we're going to do is we're going to add some entry filters. And let's add some position criteria here and some entry filters. So let's do a VIX range filter. So that's going to be the first one that we're going to allow. This right now just shows us the current level of the VIX, but let's just test. I don't know what this will do, but let's just test not entering positions when VIX is above 30. We might get a decent amount of trades filtered out for a high VIX, but maybe the logic here, and this again, just as an idea to test, is that if the VIX is really, really high by the time that we enter this position, it's probably going to be a pretty wild day. So I wonder if filtering out, really high volatility days, because we're trading a short and narrow range, we almost want it to just stay the same for the rest of the day. If that ends up improving the performance of this or not, I actually don't know. So I'm testing this with you guys as we kind of go through this here live together. So, all right, so you can see here, this is the performance of filtering out those VIX days. And what you saw is we definitely got more days filtered out. If you go down to the filtered days here, you can see we had 54 days where the VIX was filtered out. And it was, you can even look at the numbers here. You can see it was marginally above that for many of those days, just a couple points above that. At the end of the day, it didn't help improve performance. Again, this is so powerful because what you can do here is you can take an idea or hypothesis like I just did and say, which is perfectly logical on its face, that, hey, we don't want high volatility days, like super high volatility days, because we, want the stock to, or, SPX to kind of land in the middle of that zone. But what we ended up doing is we ended up taking out days with a lot of premium. And I would bet that we would have, in this case, which we did, we had a little bit less premium overall on average, which means we just weren't compensated for it. So we just took out those high volatility days where premium was a little bit higher, and we didn't make as much on those trades. About the same type of strategy. You still made money. That was great, but it really didn't work out. So let's add another variation. Let's kind of see if we can stress test this a little bit with some other criteria and filters. So let's take this one out. And in this case, let's do the percentage change since the open. So the change from the current price to the opening price. So this one's an interesting one, a brand new one that we added. So here, what we can do is we can say, look, if we get to the entry time of 230, let's say that if the market is down by 1% or up by 1%, again, testing this idea that if the market's making pretty big moves already by the time we get to 230, we don't want to do anything. We don't want to enter a tall, narrow iron butterfly in that environment. So let's do that. Let's do 1% on either end. So essentially, the market's got to be within 1% of the opening, percentage change. How did that improve performance? Okay, so it looks like it was highly restrictive. And again, we entered about the same positions, but we had lots and lots of positions that were above that range.
Okay, keep going.
Okay, so again, we're starting to see what we can do here. Even though we saw that it did not improve performance, we know we can test stuff like this. So let's actually edit this just a little bit, see if we can improve performance. Maybe we were too restrictive. And that's maybe my assumption here at this point is that we had about 159 days that were filtered out in aggregate. 70 days for minimum change, 59 days for maximum opening change. So it maybe was too restrictive. So we can actually edit a test or even run a different variation if we want to. Let's just add a variation here. And instead of allowing a 1% range, which anymore a 1% range maybe is too restrictive, let's move this up to a 2% range. So let's say, look, if the opening change is 2% up or down, we don't want to do anything. Maybe that's the threshold is a little bit bigger. So let's run this back test now with a 2% range and see if we can improve the performance of the strategy. And you can see for test number D, we actually did improve it. In fact, we almost improved it by like $1,500 or so. We improved their performance. That's actually very encouraging because now we take, again, strategy A, which was our baseline, and we've improved it with strategy number D. We've tried many different variations, obviously, and just using different things. But you can see we didn't filter out that many days. If we go in here and we look at the days that were filtered out, it was essentially about like 14 days of trading were filtered out. That's pretty cool, which means that we stayed rather consistent. But when things got extremely hairy and kind of crazy, volatility or percentage change wise, then those days were filtered out. We didn't trade essentially 14 extra days. And that was the difference for us that, we made, made some additional capital and made some additional money. You can see our profit factor, which is always a good one, just like a quick reference, increased from 1.11 to 1.3. So we're using capital a little bit better. And see our max risk was a little bit lower overall. So that was good. Our lowest P&L was lower overall. So we're kind of curbing some of that performance by just filtering out the highest days. Okay, so let's use that as our new baseline. Let's remove this test. And by the way, this is the exact same process that I go through personally. I go through this and I say, look, I'm going to, do some testing and then I'm going to remove those and see if we can add to this. Now, once we have this as a baseline, we don't have to just test iron butterflies in a vacuum. We can also add additional back tests. So let's add a back test that's a completely different strategy. And then I can show you here what we're doing by combining back tests together. So let's go in here and let's do a long put. And we're just going to do a long put. Now, the theory here is that if we can add a long put option, potentially, super far out of the money, does that long put option pay off if we add a cheap long put option, I don't know, middle of the day, end of the day, whatever. We'll test out different variations, see if we can do it. Essentially, can we get any cheap lottery ticket type downside risk? Okay. And so we're going to go all the way out here. Let's go out to like a 4 or 5 delta. We actually just made a change here so that these deltas are not in groups of 5, but actually in single delta increments. You can go down to the, 4 delta if you want to, or closest. So we're just going to buy a long put here. We're going to keep the capital constrained in this case. So we'll start with maybe we'll start with $3,000, something like that. We start with something decent, but position size, we're only going to use up to, let's say, $200 of risk. Okay. Now you can, again, change this up if you want to, but the idea here is that you can test different capital allocations. So you can start with a little bit more money, start with less money, and then you can do position sizing. You can say up to $200 of risk, which means that if you go out to that long delta, that 4 delta long put, if that 4 delta long put is worth $50, it will grab 4 of them. If that 4 delta long put is $175, it's only going to grab 1 because it's not going to go over that $200 limit. If that 4 delta long put is $201, it's not going to grab it, right? Because it would be over our position size. It's only risking up to $200 in there. Oh, I just killed all the stuff that I was doing. So let me just go back there and do that. So we're going to grab that long 4 delta put, like I said, and risking up to $200 for the position. So that should give us, again, an idea of potentially adding some sort of lottery ticket, if you will, at the end of the day. So let's remove all these. We'll still skip FOMC days. Let's move this back to like 230. or 12:30 in the afternoon. Again, at this point, I'm just testing base information. I like to do this personally. I like to just, before I go crazy adding filters, is the core or base strategy that we're trading, is there something to that? So let's do an SPX long put for Delta, $200. And it actually ended up working out really, really well. So that seems to work out almost too well. It is 3 years worth of data, but it is a really interesting one to look at and use. So the max drawdown here, this is going to be the interesting one because there's no free lunch here included in this. But you can see the max drawdown was $22,000. So even though you started with $3,000 of capital, at some point you went through a $22,000 drawdown, which is really interesting. The other thing here is that it did not win often. In fact, almost no part of the time was it a winner. 97.7% of the time, max loser. So you were trading and outlaying capital a lot, $200 at a time. I mean, many, many weeks of going through $200 losers to eventually get the very selective few that actually ended up working out okay. If you actually go to this particular strategy itself, so if we click on this strategy and just open up that strategy by itself, we can go down here to the monthly P&L chart, and you can see basically what would have happened. You can see that for many months you were outlaying $2,000, $3,000, $4,000, and it was only a couple months that actually turned this thing around where you had some really big wins, right? So there's probably a couple months where the market just absolutely tanked and that strategy turned into a winner. That's interesting. That's something you got to take, look at, because if you don't have the stomach, and I think this is part of it, is having the stomach to get through a lot of these kind of trading days and a lot of these trading months, that is probably not the strategy for you. Even though the end goal might be there, it's probably not the strategy that you would want to trade. Okay. So let's go back here. That looks like a pretty good one. So we'll keep that one here and use that one moving forward. Let's also add another one. Let's add a different version. Let's also add a short call spread. Let's see if we can get something that is, maybe we do something a percentage above where the stock is trading right now. So let's do something, actually, let's do a delta. We'll do a 30 delta or closest short call spread. And let's do the long wing. We'll do that one. Let's do it $10 above the short call leg exactly. Okay, so we'll do a wide short call spread. We'll start with a small amount of capital. I think that's where I did that one, that other one. We'll start with a small amount of capital, maybe $4,000 here. Only do one contract. So we'll just do one spread here, see if this thing ends up working out well. And we'll do it later in the day. Maybe we'll do it 1:30 in the afternoon, 1:45. Let's just test some different stuff. And this time what we'll do is we'll take off the entry filter. And what we'll do here is we'll add a indicator where we only get into this position if RSI is above 70. So we'll do anything. Let's filter out really low RSI. So we don't want to get into a position right before it rallies. But the max one here is going to be, or actually we'll do this. The max here is 70 to 100. So if RSI is high, that's the only time we're going to get into this. There's a little bit more of a selective strategy, and I'm just doing this because of time constraints. We don't have the time to go through just the base model, but I would test this base model first, see if there's anything there. But I want to show you guys how you can test this with different exit options, etc. So we'll do this one, and we'll also do this one maybe with a quick profit taking. So if you get to 50% of credit, let's take the profit, remove the position. So this would be high RSI. You sell a call spread, you're kind of fading the market. The market's up. You're looking for maybe a reversal towards the end of the day where midday, 145 or so, market's super, super hot. Then it reverses by the end of the day. So a couple, 3.5, 2 hours and 45-minute trade. Let's see if this thing actually does anything for us. I don't know. And I'm just throwing stuff in here, seeing if it actually improves the performance of this strategy or not. Okay. So it actually is okay. It's decent. It made $202. Let's actually edit this. Let's create another variation. It didn't look like it was that good. So let's move this one up. Actually, what I usually do is I go in here and I see why was it filtered out? And you can see most of the time it was filtered out for RSIs that were 57, 48, et cetera, et cetera. So let's move that RSI filter down just a little bit. See if we can improve performance by going down to, let's go down to 60 and see if we can improve performance by going down to 60 RSI. Maybe 70 was too aggressive. Maybe if we go down to 60, we do better. And you can see here, we actually did significantly better. So the difference between these two is literally entering the positions at a 60 RSI versus a 70. And it's literally night and day. In fact, on its own, if you don't have this one here kind of crowding out the visual that you see here, and I can just remove that one if we need to, so you can see, remove this test. If you don't have this one kind of crowding out the visual, you can see that this one is actually a much better strategy than B. B didn't trade almost at all. So B, which was entering only with RSI above 70, really didn't trade at all. C, you entered RSI above 70, you had one of the better profit factors in here, super high win rate, which would be, generally expected. And you didn't trade that much. You were kind of being very selective, very picky and choosy, about 244 trades. So you didn't really trade that much. You got a pretty decent, run. That was a very good one. And a lot of them were taken at profits. Now the exits here are pretty fascinating down below. You can see here for this one, this one shows which ones were taken for profits, which ones expired. Remember this first strategy A, our iron butterfly, we just let go to expiration. So we didn't have a profit taking, just kind of set it and forget it to a certain degree, like set it and let it go. And then you had strategy B, which we introduced profit taking. A lot of profits were taken. Strategy number C here, you can see even more of the position was taken with profit. So let's add one more variation here to kind of finish this one up. And instead, let's actually mess around with this profit taking. Let's test profit taking a little bit less, maybe 25%, just to see if it improved. We had a lot that hit 50, which was good, but maybe taking faster profits might have improved performance. It might have, hurt performance, and we made less money. And you can see it did actually dramatically hurt performance. So there's this balancing act here, definitely with taking profits, and just even in testing where you can see this. Is that, a lot of people say, oh, you got to take fast profits. Well, it might be different for different strategies, right? In this case, if we look at C versus D, it's the exact same strategy. C was doing really well. And so we think to ourselves, okay, maybe we take profits a little bit sooner, a little bit earlier. Yes, that improved your win rate. You had a really good win rate here at 91%. So you feel good winning a lot of trades. You just didn't make any money doing it. So let's actually do the opposite. Let's test a variation where we go here and we test a little bit higher profit target. So let's test 75 in this case. So let's go the opposite direction. Let's not go down to 25. We'll go back to 50. 50 works, right? So now does 75 work? Okay, great. 75 works. Your win rate went down. That makes sense. You're holding the position a little bit longer, but at the end of the day, you're making a little bit more money. Your profit factor is a little bit less. So maybe it was just kind of a cyclicality thing. It may not be one you want to stick with, but overall, you made a little bit more money on that particular strategy. So I like actually C a little bit better. Personally, I like it because the profit factor is a little bit better for this one. Your lowest P&L was a little bit better. You had a slightly higher win rate. So I kind of sacrifice a little bit of that total win for something that seems like it might be more consistent moving forward. You can see E was a little bit more choppy even, and just kind of barely beat out this test number C just in the last couple of weeks. So it wasn't the winner for the majority of the time period like C was. So, all right, so let's remove these. I'm going to remove this test. I'm going to remove
Okay, go ahead.
All right, so we're going to remove D also because I don't, D we don't really like either. It didn't really make any money. And then we're going to remove B. B was the first test, first variation of this. That didn't really make any money either. So we're going to go ahead and remove that test. So now what we have is we have this chart. And this is two strategies. We'll just keep these two strategies for now because it kind of visually does a good job representing, where, and I think, and I'm glad we got to this point here where you can see these two, because what it does to me is it visually represents two completely different strategies that you can run, which independently of one another, it's almost like, to a certain degree, one zigs when the other zags. It's not perfectly true that, they zig and zag and they're perfectly inversely correlated, but it is true that they have different profiles. One is very consistent, lots of entries, lots of repetition. And the other one is only entering positions at certain times with certain criteria, like, RSI or above a certain level. And so what we can do here now, and this is, I think, some of the most powerful things that you can do, is you can now click this button up here to combine the results. And what that does is it takes the joint performance of these strategies on any given day, and it combines the results into a total kind of combined P&L. And you can see what would have happened had you included both of these strategies in your trading. And this, to me, is very powerful when you start thinking about building automated strategies and portfolios, using backtesting as kind of your logic and your data engine to inform your decisions. So now if I hit combine results, these results are pretty good. The P&L curve is very manageable. You definitely went through a drawdown early on. That's okay. Manageable, but it stayed pretty consistent. You didn't have these insanely wild swings, and you end up being net positive where you had two strategies kind of going simultaneously. That's really good. That's what you ultimately want, is something that you feel comfortable with, that you might want to turn into an automated strategy. So the last thing that we're going to do here now is we're going to take this and we're going to turn it into automated bots. Now, one of the coolest things that we do here at Option Alpha is, of course, the ability to auto trade. So if you have a strategy you like strategy number A, you're like, hey, I want to trade this one and I want to trade B, no problem. All you do is simply click on the three dots next to that strategy and click the button to create a bot. Now, what this is going to do is it's going to take all of the information that you just backtested. So you spend your time doing the backtesting, and then it will convert it over into a bot for you. Basically build the bot based on your backtest for you to run. So I can say Kirk's SPX Iron Butterfly afternoon, or whatever the case is, however you want to name it. I connect it to my main Tradier account so you can trade this live in the market. Then give it a capital allocation. You can see the same allocation that it was used before. And the entry time and the scan is right here. Now, you can modify this if you want to, but there's no need to modify it in my view, because this is what we actually tested. We actually tested scanning and looking for a position right at 230. That's it. And then you can change up any of the pricing if you want, or confirm how you want pricing to go as you move through the bot. Now, once you hit create bot, that bot has been created for you. And so now if you go over, and I think this tab is now sharing, which is good. Yep. So you go over and you look at this bot. This bot has that entry scanner with all of your market conditions, all of your entry criteria, exactly how you tested it, everything, right? The S&P change is greater than or equal to 2 since yesterday. This is right here. It's all built out for you. Market closes at 4, not an FOMC meeting. It's got all the entry criteria you tested. We just basically built the bot for you. And all you have to do is turn on your automations. That's it. And so now this bot is running that strategy for you. So that one's done. So now we go back here to our back tester, and we go down here and we do the same thing for this one. So we go in here and we say create bot. We say Kirk's SPX short call spread, or whatever case it is, right? You can say something even more specific, like RSI 60 plus, however you want to name it, doesn't really matter. You go to your main Tradier account so that all the trades are flowing through your Tradier account. And then again, you just go down here and create bot, and it's done. And now that bot has been created. So at 1:45 every day, it will check all the market conditions, right? And then it will check indicators, and you can see it's RSI above 60 or below 100. That's it. All the stuff is entered in there for you based on your backtest. It's exactly the same. So you have confidence knowing that what you backtested is now going to be executed in the market. And then you simply go here and you turn on automations. And that's it. So we wanted to make that process as simple as possible, because most of your time should be spent here backtesting, should be going in here and saying, can I do this and this and this? Can I take this short call spread here, and I want to combine it with this Iron Butterfly and this long put spread, and I want to take these and I want to look at this combined portfolio and see, can I improve the performance of the combined portfolio? And you can see you can, right? And this is where you spend your time. You spend your time backtesting here. Then you just automatically take those backtests and turn them into bots that trade for you in the market. So you can come back here and do the things that you're really good at doing as a human, as a portfolio manager, which is testing, analyzing, choosing, not the things that you can have a computer and a robot do for you, which is finding positions, doing calculations, monitoring the market. Let bots and automations take care of that so you can focus on the more important stuff. So I hope you guys enjoyed this here today, going through kind of what that process looks like. I spent a lot of time in the backtester myself, run backtested strategies myself, also in my live account. I hope you guys enjoyed this and it was very helpful. If you need anything at all, please let us know, add a comment, shoot us an email, post in the community, whatever works for you, and we'll see you on the next episode.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.